Subros Limited, an auto component manufacturer, posted a weak set of numbers in the September quarter, driven by lackluster auto demand. Let's do a three-point analysis to find out if the company could still be on the investors' radar. 1. Key highlights of Q2 FY20. Well, in Q2, the net revenues declined because of weak demand from the car segment. Revenues fell 12% and operating profits by 25.6%. The home AC segment could not arrest the fall in the revenue, as Q2 is a seasonally weak quarter for this category as well. 2. What's the industry outlook now? Well, the Indian auto industry has been facing multiple challenges arising out of the weakening macroeconomic environment and some of the specific issues to the industry. Factors such as liquidity crunch, slowdown in the economy, mandatory long-term insurance, as well as others, have really hurt demand. However, we believe that the slowdown is cyclical in nature and that the long-term growth outlook continues to be quite positive on the back of low penetration levels and increasing disposable income. Now, the management expects Q3 of the current fiscal also to be muted and believes a recovery will take place in Q4 FY20. 3. Should one look at adding Subros to the portfolio? Well, Subros is a market leader in supplying automotive AC components to original equipment manufacturers in India and has garnered a market share of 46%. Now, additionally, Subros is also expected to do well on the back of its order pipeline and also the new wins. Now, another important trigger for the growth is also the mandatory fittings of ACs in the air blowers in the truck's cabin in N2 and N3 categories. Subros has achieved 70% market share in this segment as well. Now, the total annual industry opportunity for the company is around 100 to 450 crore rupees. Apart from the trucks, Subros is also supplies components to the railways, where it has already achieved a market share of 77%. Now, Subros stock price has corrected 44% from the highs of January 2018, making valuations reasonable. The stock currently trades at 17.8 times FY21 projected earnings, and investors can now look at accumulating the stock in the current dips.